to introduce our next speakers. And
that's my cue. Thanks,
okay,
Beth.
that's your cue.
All right, good morning, everybody. My name is Nathan Fay. I'm the director of the Colorado Outdoor Recreation Industry Office, and also for this year serving as co-chair of the Confluence of States, and have the pleasure of moderating our first session for the NGA ORLN annual summit here, which is on state coordination in support of outdoor businesses during COVID-19. So by way of intro real quickly, small businesses, I think we have all witnessed, we know they're economic engines in states, and we know that they've been drastically impacted by COVID-19. In the state of Colorado, we launched 2 programs that were geared to helping small businesses, and including outdoor recreation businesses, excuse me, navigate some of the constraints that we were all feeling during the pandemic. Those 2 programs include the Climber Loan Fund, administered by the state, and the Energized Colorado Gap Fund that is using private CARES Act and private dollars to provide support through loans and grants to help small businesses navigate the past few months. So to have a focused conversation on both of those programs, we're joined today by 2 close colleagues of mine, Jeff Kraft with the Office of Economic Development and International Trade. He's the Director of Business Funding and Incentives. We're also joined by Jason Bertolacci. Many of you know Jason was the founder of Berber LLC, a public relations firm, and is now serving as the Chief Operating Officer of the Energized Colorado Gap Fund. So Jeff Kraft now works within OEdit, but he comes from, in his previous career, spent, I don't know how many years in the Fortune 20 space and corporate world, working as an executive from Fortune 20s like AT&T all the way down through small startups, and has a fantastic education with a BA in economics and political science and master's degrees in public policy and real estate. Jason has a very diverse background, and I've enjoyed working with him for a number of years. He left the world of technology startups to pursue a passion in mountain biking, where he served as the regional director in Colorado and Wyoming for the International Mountain Bike Association. Soon after leaving IMBA, he formed Berber LLC and continues to work with a number of different clients, including the Nature Conservancy, the Colorado Office of the Outdoor Recreation Industry, philanthropist Kent Theory, and now is heavily focused on Energized Colorado Gap Fund. So I'm going to ask these 2 gentlemen to walk us through each of their programs, and then we will have time at the end to focus on Q&A from the audience. So I will start with you, Jeff. I know that we have a couple of slides to help illustrate the points that you're going to make, but I'd ask you to give a brief overview of the business support programs that you're presenting here today, and we can dive into more specific questions once you've done that.
Thank you so much, Nathan, and it is a tremendous pleasure to be speaking to you all here today. I know you'll bring up our slides, and what you'll see on the first slide is just an introduction to the Climber Loan Fund, and I'll just make a point on that slide. The outdoor recreation industry is so important to Colorado. It was natural for it to be emblematic and to sort of structure the Climber Fund. I mean, it has a meaning, Climber, or Colorado Loans to Improve Main Street Business Economic Recovery, but the metaphor is outdoor recreation related. And so many of our small businesses are outdoor recreation either related or adjacent, that we just, everything we do in Colorado is outdoor recreation related, and Nathan is an unbelievable and passionate advocate for that. So it's critical. Your industry is totally critical. Nathan is right. The fund itself is sort of sector agnostic. But a couple things that I'd say is, basically we recognized really early on that this crisis could be serious. It could be longstanding. We don't know for sure how the federal government might react. And while the federal government has a checkbook that will dominate anything we can do at the state level, including the upcoming PPP loans, we think our small businesses will get another $6 billion out of the next tranche. We still think it's critical that you leverage state dollars as much as you can with private dollars to supplement the federal government, or to the extent that the federal government doesn't act in a perfectly timely manner, to do what you can from a state perspective. But we knew there'd be huge gaps even after some big federal actions. And we knew that there were tremendous equity concerns for underserved communities, but also geographic diversity. Rural Colorado has definitely lagged historically since the Great Recession beyond our urban Front Range. And we know that outdoor recreation is an incredible tool for rural Colorado. But so we also had this idea that our need would be long-term, that there probably wouldn't be a V-shaped recovery from the COVID health crisis. So those were all sort of considerations that we know we needed to do something. And this came out of work that Governor Polis had pulled together with the private sector. And so some of the things that we thought about, Colorado, like every state, and maybe even more so than many states, we have unbelievable fiscal constraints, including something called TABOR, which I won't get into, but it basically hamstrings our ability to raise state funds. So we wanted a program that was fiscally responsible, fiscally viable. I'll talk about that in a second. We knew we had to leverage public-private partnerships. Jason's version that he'll talk about in a second sort of leans more on the private side. The version I'm talking about, as Nathan mentioned, is state administered, but there's lots of public-private partnerships involved in it. We have a volunteer fundraising group that's going to raise capital from private sector banks, and we are definitely leveraging all of our sort of existing lending systems. And also, given the fluidity of the environment, right? We don't know what Congress is going to do. This has been underway, planning for this, since early part of COVID. Don't know what the federal policy environment would be. You have to be fluid. You have to be able to adjust your program to fill in the gaps. And just to give you a sense, our goal is to have $250 million available. And what I would also say is, one of the things that we've definitely learned is the needs are so large, you can't have a single entity drive everything. So Climber it's led by the state treasurer, the governor's office, of which my agency is part of, OEDIT, is coordinating, working with them. But while you need multiple different bodies, public, private, taking the lead, you also need to try and coordinate and have things fit together in a reasonable way. So that's just a quick high level about some of the thoughts about setting up this fund. I'll say move to the next slide. And this is just a nitty gritty. The next slide is really just a nitty gritty. Who is covered? And I'm frankly not going to spend much time on this. I want you guys to be able to see this. I'll say that it targets not the smallest businesses. It targets sort of the small to mid-range businesses, and it targets those businesses that were financially strong pre-COVID, but were knocked backwards and might not be able to get private capital based on an interruption of their cash flow that occurred during COVID, but that we believe have a track record of strength and good management teams. And so it's not targeting, Jason's going to talk about targeting the smallest and most vulnerable, which we think is critical. It's targeting a slightly different class. And part of that is we wanted to make sure that we could raise money from private investors and they would feel confident they would get their money back. So there's a little bit of a targeting of those businesses that were strong and hopefully will be strong again once we get through these cash flow interruptions. So you can the other point I'll make is we tried to make this complementary to things like the Federal Reserve's Main Street Lending Act. So it's a little smaller than the original size of those Fed loans, and complementary to PPP. And one thing that we thought was really important is we wanted to have a lot of flexibility for the use of proceeds for Climber loans. We wanted to make sure that those loans could be used for not just payroll, but for any other kind of regular occurring expenses, including they could be used to make regular debt payments. So one of the things that you can do is you can extend what hopefully is a 1 or 2 year dislocation of a business's cash flow and extend it over 5 years. And we thought it was critical. We were putting state money into this as first loss money. And I'll talk about that in a second, but we were putting $50 million into what will ultimately be a $250 million fund. And the state subsidy is first loss money. And in exchange for that, we want our lenders to provide below market interest rates, because these businesses, even if they can handle a little bit of extra debt after they get their PPP loan forgiveness, they can't handle high interest rates. So we want to make sure the interest rates were really reasonable. So that's a little bit about the loan terms and the types and sizes of businesses we're targeting. And then I think a really important thing is the fiscal rationale for this. As I alluded to, obviously Colorado has a very tight state budget. We have low tax rates and we have prohibitions on raising new taxes. So one of the insights for this program was it had to be very fiscally friendly. When we actually designed this program, we got state money during a time period when our budget was being massively slashed. So if you move to the next slide, I mentioned that there's going to be $50 million in state money. The way we chose to raise that was really interesting. We sold tax credits to insurance companies that know they'll have tax liabilities. We're selling them literally today as we speak, but they won't be redeemable against state taxes until 2025 and 2026. So that $50 million will hit our budget over 2 years when hopefully we've returned to a more stable budget. So it was this insight of using this tool of selling tax credits today to raise cash today that did not affect the state budget today. And then the other point is we did a lot of modeling. I've sort of summarized that on here. The modeling basically showed that if you use these funds to save businesses and save jobs today, that saving those jobs will allow people to continue to make income tax payments from their salaries, continue to buy things and make state sales tax payments, and will avoid strains on the safety net program. And so by the time we have to pay for those tax credits in 2025 and 2026, the state will have saved money in 2021, 2022, and 2023, et cetera, by getting extra tax revenue. So it really is like an NPV positive program where we save money early and we have some modest costs later when our budget is stronger. So I think, being really intentional and thoughtful in designing these programs to fit the constraints of the situation, and knowing, that this can be a tool that can help all types of small businesses across the state is kind of the high level point I'd like to leave you with. And I'm really interested in getting into the questions and hearing what you all are seeing and doing in your states and being able to dive deeper. And then with that, I think I'd love to stop doing slides and kind of hand things back to Jason.
Yeah, thanks, Jeff. That's a great overview. Jason, let's move to you and we can talk about CARES Act and private dollars from a different perspective.
Good morning, everybody. Jason Bertolacci here with the Energized Colorado Gap Fund. I actually came from the outdoor recreation world, so it's a little bit of a new program that I'm working with here, working on the fund side and the entrepreneurship side. But it is an important program that is a sister fund to what Jeff was describing. The Energized Colorado Gap Fund targets smaller businesses, under 25 employees, including sole proprietors, but was also conceived in a similar manner of being an ultra low interest loan programs for small businesses. Where it differs with the Climber Fund is that rather than using state money to provide or essentially underwrite the loans for that lower interest rate, we have first loss money from private interests. We have foundations that have made investments in our fund to allow us to offer an interest rate to small businesses of about 1% over the life of the loan. But this fund was specifically designed around the idea that there were certain business owners in certain communities within Colorado that have historically had hurdles of accessing capital. And those businesses and those owners have only been harder hit under COVID. And so we're really looking at what were the gaps in the capital system and how can we plug those gaps with an ultra low interest loan program. So we're currently distributing $36 million in both grants and loans. But we're doing it with an equity lens. And so we're specifically preferring businesses that are owned by women, veterans, minority-owned businesses, or BIPOC-owned businesses, and businesses in rural Colorado. And so the fund isn't exclusively for those businesses, but it does have a strong preference for those businesses because of the economic harms that they're seeing under COVID that are much greater than other segments of the business community, but also because of the historic harms that these businesses have had and the hurdles in accessing capital. It is a public-private partnership, which is another difference from the Climber Fund. So there's actually three main entities that are involved. OEDIT is of course one of the funders and is our state partner. The Colorado Housing and Finance Authority is actually the fund administrator. And then Energized Colorado is a 501c3 charitable nonprofit that the fund sits within and has an executive committee that actually provides oversight and direction for the fund, make sure that it charts to that equity mission. And so that we can then utilize that type of a partnership for outreach, for support, for technical assistance, and all the different aspects to bring to this program all the resources that are needed to serve the most underserved businesses in Colorado. So as we were setting up this ultra low interest loan program, the state legislature in Colorado, the General Assembly, was looking for a way to help small businesses and was also trying to find a way to help small businesses that fit within Energized Colorado's mission and that equity focus. And so allocated $20 million of federal CARES Act funds that had come to the state to our program. And then another $6 million was allocated through executive order by Governor Polis. So we had to be nimble and switch up from an ultra low interest loan program, which we were developing but hadn't launched, to a federal grant program and build out a federally compliant program that distributed these CARES Act funds at $26 million before the deadline within the CARES Act, which was December 30th of last year. So we had a very short timeline of getting the money out. The money in terms of grants was capped at $15,000 per small business. So there was quite a bit of work that needed to be done to actually get this capital out into the community and get these grants out to the community. One thing that makes this very relevant for this audience is that the money that was allocated to us from the CARES Act, these federal dollars that came through the state of Colorado, there was a $5 million earmark for tourism businesses. And OEDIT and Nathan's office and the tourism office made sure that that earmark was there because, as Jeff pointed out, and as each of you know, the outdoor recreation industry, the tourism industry, are incredibly important to our economy across the state, but especially to rural Colorado. And that's one of our priority groups as well. And so this was a way to make sure that funds got directed to those hard-hit communities in Colorado that just weren't seeing the type of economic generation that would happen under a normal economic environment. So we opened in late August, and we received over 2 rounds of open application periods, 10,000 applications. The demand was huge. In fact, we had about $240 million of requests for assistance in the applications that were received. And again, this was a blended grant and loan program, but the amount of applications and amount of requests for assistance received was massive. And it just speaks to the depth of need out there for these types of programs. And obviously the $26 million that we had on the CARES Act side for grants and the additional $10 million that we have for a loan program is nowhere near enough to satisfy all of that need. So we were having to prioritize in a highly competitive process those 10,000 applications. And so we used a prioritization rubric that elevated our priority groups, but also elevated businesses that had the highest impact in their community. And through that process of prioritization, we were able to award about 2,000 grants from the CARES Act funding and allocate all the $26 million of that funding that we had received before the deadline at the end of the year. But for every one of those businesses that we are able to fund, there was 4 that we weren't able to fund. So there's still a huge need out there, both at the federal level of being able to advocate for a further CARES Act type funds, but also at the state level as well. So there is a lot of opportunity for each one of your offices, not only to work within your state, but also collectively at the federal level to make sure that money gets routed in a way that can be most impactful to the small businesses in your community. And so I think that's a real fertile ground for this group to think about is how we can generate more funds of these types and start launching more of these programs. We know there's a lot of these programs in a lot of other states, but hopefully this is a illustrative example of how we can try to make sure that some of these businesses survive the worst of the economic harm. And with that, Nathan, should we go to questions?
Yeah, let me ask a couple before we turn over to the audience, and everybody participating, if you would like to start submitting questions into the chat, we'll be sure to address those as they trickle in. Let me start with a few for both Jeff and Jason. The landscape around business support has changed pretty significantly just in the last week. Can you, I guess my question to you would be, how did these programs complement or conflict with some of the new federal stimulus programs that we're working to distribute?
Nathan, I'll just jump in. I would say we explicitly designed the Climber program to be flexible And it certainly could stand on, if there were no federal programs, it would be useful, but just a drop in the bucket, right, to support the small business needs. It'd be one little small piece. But I think it's complementary because we've made our use of proceeds very flexible, and in some ways, compared to, for example, the PPP program, they're both sort of funding operating costs, but we made our proceeds much more flexible in terms of what operating costs they could cover. And the way I think about it is, with PPP, it's amazing news that that's going to launch hopefully in the next few weeks. That will save a lot of businesses that otherwise during a really dark winter might go under. And then those businesses, as things get better and better during the rest of the year, will need additional funds to sort of ramp up and rescale. And Climber can help provide that. And one of the things we thought about for Climber is it's going to be available for a couple of years, right? So these waves of federal grants and federal funds are great. Climber can help a long-term sort of climb out of the desert. So I think thinking about how these can be complementary and knowing that the needs are enormous, we did some math and some analysis during the first round of PPP, and the needs were multiple greater than the funds that were provided. So I think that both in needing extra funds, but the way you design your programs to be flexible in the way the proceeds can be used are critical.
Yeah, and throughout this, we've had to be flexible and nimble. It seems like, I think for all of us, the next day and the next week brings something completely new. And so we find ourselves in a little bit of a different landscape, here in early January as we were in late December. And that is, the market is going to be flush with PPP capital. But like the Climber Fund, the GAP Fund is, the loans, and as we turn to the loan program here in early January, our loans are going to be more flexible. Our loans also come with a heavy equity focus, and we're specifically trying to plug those gaps for businesses who weren't able to qualify or make it through the PPP loan process. And so we can have much riskier loans because we underwrite the loan loss for our lenders through donations. And so we see these as complementary tools, but the bottom line is we do have to be flexible and have to constantly reevaluate what the gaps are, and make sure that we turn and pivot to be able to fill those gaps and make fund products and loan products and grant products that meet businesses' needs. So we have to be really responsive.
Jeff, another question to you. I guess I recognize that many of the participants here today are in the process of creating similar programs or looking at Colorado or this program as a model. Can you speak a little bit more to the kind of the coalition or the group that was convened to work with the legislature to establish Climber Fund, and then we can follow up from there?
Yeah, I mean, one thing I'll say is, Governor Polis did a really great thing, and that was he convened a broad set of private sector stakeholders to kind of identify the needs. And so there was a group of, private equity type folks who'd been through many recessions and said, this one feels tough. It's going to be a long-term need. We need to put in place some long-term tools and programs. And it really built a bipartisan coalition of sort of, think of like the good government types and sort of the civic booster types that were both Republican and Democrat that got behind this. And so starting with that broad-based coalition that allowed, a good political coalition to form within the state. And then we made sure, for example, there were provisions in our law that said you had to have geographic equity in terms of how you disperse the loans. So not all the loans could go to businesses in one community right away. You had to make sure that even the smallest communities that might be a little slower off the starting gate would get access to the loans. And we also have some measurements to make sure that the loans were distributed in tracking them to make sure they're distributed in an equitable way in terms of underserved communities and people of color and historically low-income communities and things like that. So I think building a broad coalition was really important because our program, was critically seated by the state legislature, and so having that broad coalition was really important. And I think some vision driving it originally from the private sector was critical. So those were some really critical pieces that I can think of. And again, being very mindful of the state budget and how, we're cutting every program in the state, including critical programs that, help vulnerable people in many ways, and school programs were cut. And so how can you justify this in terms of how is this going to be additive to the state budget, not just subtractive? So I think that's a critical consideration.
Thank you, Jeff. And Jason, do you have any comments you want to offer around the legislator's support for this public-private partnership with the GAP Fund?
Yeah, and our path to be a public-private partnership was very intentional. Energized Colorado actually offers a host of other services beyond the GAP Fund. So Energized Colorado has subsidized PPE procurement, mental health service, free and low cost for businesses to provide to themselves and their employees. Also has mentorship services. We set up a fully staffed help center to make sure that folks could access all those services, including the GAP Fund, because we recognize that a lot of times capital in and of itself, a loan, a grant, that is not enough to make a business successful, especially in these trying economic times, that you really need to have wraparound services to be able to do that. And so the way that we went about doing this was to create the private side of it in partnership with Jeff and the state to be able to provide some of those services and do a lot of that through volunteer labor. Because there were so many folks who raised their hand in the wake of the COVID-19 pandemic who just wanted to help. And so Energized Colorado became a focal point for a lot of those folks in the state that wanted to help. And I think that type of a coalition was really powerful when it came to the legislature looking to where it could allocate some of the CARES Act funding in a way that they thought could be impactful for businesses. And then the early numbers and the early strength of the program was what led to the additional $6 million allocation for Governor Polis. And then having strong partners at the state like like the tourism office, OEDIT, and Jeff and his department, I think that obviously was part of the reason we were able to direct some of these funding to small businesses in this way.
Great, thank you.
So Nathan, there's a question in the chat box. Could I pose it?
Yeah, from Cassidy. Great.
Yeah, or you see it? If you see it, go ahead. I just wanted to make sure she got that question in.
Lots of questions, Cassidy, but I think generally to the crew here, it's more, we're looking for more specificity on how we were engaging the private sector in raising funds. So Cass's questions are, are investors getting a return or a tax benefit? Who did we target? Lenders, major corporations, private donors, is it crowdfunding? And generally, how is the fundraising effort going? And then Jeff, there's going to be probably a follow-up for more clarity around the idea of selling tax credits, because that always piques everybody's interest.
Jason, you want me to take the private funding? Yeah. And so for private funding, we have targeted major individual donors, but primarily foundations. So we've gone to the foundation world and we're soliciting not only donations, but we're soliciting program-related investment, which is a charitable contribution, but it's a charitable contribution that gets repaid to the foundation. So they're essentially loaning us money that we then in turn loan out to small businesses. And so we've been able to take both the donations and those program-related investments, or PRI, and utilizing the donation dollars to essentially guarantee the return on investment of those PRI dollars. So we calculate that for every dollar that we bring in as a pure donation, we can bring in about $5 of loan capital that can go out to businesses. So there's a really strong multiplier effect there. And that's very attractive to the foundational world. It's also very attractive to individual donors also. And then both Climber and GAP are working with banks, but primarily the Climber Fund and working with CRA investments or Community Reinvestment Act investments. And Jeff can talk more about that. But we're not offering on the GAP Fund side any return on investment on the program-related investments. The PRI are loaned to the GAP Fund at a 0% interest rate. So these are mission dollars, and these are just ways for foundations to make their corpus and their giving, more impactful because they'll get these dollars back. Though the maturation date on those PRI is about 6 years, so we'll have those funds and be able to recycle them to the community multiple times.
Yeah, and so just as Jason alluded to, and there is a lot of partnership between the fundraising team for Climber and GAP, including some leadership from the GAP folks in making the sort of volunteer ask to the banks. But basically, the Climber Fund has two sources of funds: the tax credit proceeds, which I'll talk about in a second because I heard the second part of that question, and that's aiming to be $50 million. And then we're trying to raise $200 million of private capital, not from most of the groups Jason was talking about, but from banks. And it is going to be Community Reinvestment Act dollars, mostly from the banks. And so they are very interested to make sure that the loans that are made by the Climber Fund will be Community Reinvestment Act compliant, so that they'll be distributed through nonprofit lenders in some cases, other cases through banks and credit unions, but that they'll target, for example, designated low-income areas and things like that, that will allow the banks to get Community Reinvestment Act credit from these loans. And the other thing that we're doing is because the Climber Fund could be as large as $250 million, we're doing tranches of $50 million that will have $10 million of state money in each tranche, $40 million up to of private money, and that therefore the banks can make a commitment for one or two tranches, see how it goes, and then fund future tranches later as needed. So because Colorado is a relatively small market, like we couldn't raise, $250 million like a New York or a California might be able to do right away. We're kind of doing it in stages, almost like proving our success as we go. So that was one of the insights from a fundraising perspective as well. With regard to tax credits, that's a really powerful tool. It's even more powerful in Colorado because of our Tabor constitutional amendment. But what I would say is, if you think about it, if you sell a tax credit today, and you sell it to an insurance company, and the reason insurance companies can be really important is they are typically taxed on their gross premium receipts. A lot of companies, their state income tax goes up and down based on their profitability and business cycles. Insurance companies have long-term policyholders. They have very stable revenue on their insurance premiums, like life insurance and other kinds of insurance, and they have to always pay a tax whether they're profitable or not. So they're very willing to buy a tax credit because they know for years in advance they're planning to pay taxes. And typically what we did is we were selling tax credits, today that won't be redeemed for 5 or 6 years. We have to sell them at a discount, right? Because the insurance companies need to get a return. And so we're selling them, basically think of in the range of 75, 78 cents on the dollar for tax credits that'll be redeemable, obviously at fully on the dollar 5 or 6 years from now. And the beauty of doing that is there's no short-term impact on the state budget. While we're experiencing all these budget cuts, really painful, horrible budget cuts, we think that our budget's going to return to normal in 5 or 6 years, and we can much more easily afford that $50 million or more in tax credit redemptions in 2025 and 2026. So that is a really powerful tool. Other states have done it. We've done it to fund other programs in the past. We do it on a highly limited basis because you have to be careful. You obviously don't want to just give away all of your future revenues and not have a sustainable government either. But we saw this as a crisis, and that a crisis called for action. We needed to raise money so the state could subsidize the private capital, so the private capital could feel comfortable it would be returned to the investors. And we didn't want to cut other services, so this was our sort of solution there.
Fantastic, thank you both. So another question in the chat's coming from Mary in Wisconsin. Jason, for you specifically, the loans, are they systematically given or processed through OEdit, or have you established a 501c3 to run the grant loans?
So, and there's actually, that's a great question. I'm glad you asked because I didn't touch on this before. We did create a 501c3 to provide direction to the fund itself, but it is actually acting at a high level, tracking the overall fund to its equity mission and its impact mission. And so that's where the 501c3 exists and also has the wraparound services that I was mentioning earlier. But then we actually partner with the Colorado Housing and Finance Authority, who I mentioned was the fund administrator. But we also partner with 14 different nonprofit lenders across the state. So these are community development financial institutions, revolving loan funds. They're specific lenders that have nonprofit charitable missions to serve certain segments and demographics within the community. And they're very sophisticated organizations that are very mission driven. It was an area of entrepreneurship that I was completely unfamiliar with until we started working on this program, and it's been fascinating to learn more about these organizations. But the CDFIs are the ones who have processed and actually written the check on the grant side, and they're also the organizations that will be underwriting the loans, utilizing the product that we're providing them. So those organizations, those nonprofit lenders, have been incredibly instrumental in the work that's been done for the Energized Colorado Gap Fund. The CDFIs will also be a part of the Climber Fund, but Climber's working with a larger array of banks, and including community lenders and CDFIs. And so that is a really important aspect of how we're getting this money out in the community.
Okay, you guys, I have one more question for you. It's more about replicating these programs in other states. Are you familiar with other programs existing outside of Colorado? And the sub question to that would be, what are the lessons that we've all learned, or the pitfalls that we've navigated in establishing these kind of emergency assistance programs?
Yeah, I'll jump in real quickly. I mean, I think there are hundreds of programs across all 50 states. Every state has some kind of a program for sure. A couple of things that I would think about at lessons are, it takes a village, right? I mean, both the mission of the Climber and the Gap Fund are critically important, and neither one could do what the other one is doing. So having lots of different resources and being willing to have them coordinated, but really leveraging and having different actors doing different parts of the lift. Like I alluded to with Climber, the state treasurer has the lead, the governor's office coordinates, but I think being able to have different programs is really important. I think it's worth having some sector specific programs if you have the resources. So for example, those of you, obviously you're working in your outdoor recreation industry, if you have the resources and the capacity and support structure to launch an OREC specific program, I would never discourage you from that. Because it can really help your sector. But at the same time, what I would say, you should always have the ear of the people that are working on sort of the bigger sources of capital. You should be aligned closely with the SBA so that you can really help spread the information about PPP and SBA lending and EIDL programs to your constituents. You should also be working with people that are designing sort of the multi-sector state programs so that you can make sure they design those state programs with your businesses in mind, that they're going to solve your needs. So I think that is critical. One thing I'll say with Climber, the legislation happened in the spring and things have changed since then. And I would say if you do need, obviously one is thinking about your state legislative cycle and the timing of getting bills done and bills approved. But secondarily, knowing that these programs may last for several years, you have to be as flexible as possible. We did a pretty good job. But one thing we did is at the time we said we thought we would stop funding new tranches of Climber loans by the end of the state fiscal year next year. So June 30th, 2022. We're actually thinking that's too early. We think we're going to need to be funding new tranches all the way through 2022. So we're probably gonna have to ask the state legislature to extend our authority for another 6 months. So to the extent that you can work, the legislature doesn't like giving obviously broad authority, and they want these things to be as short and tight as possible, but push for flexibility. Know that whatever you do today, you're gonna have to change it 3 times before you're done. So keeping as much nimbleness and flexibility and not building constraints and limitations that you don't need to into your program. You need guardrails, you need accountability, you need limitations that are politically acceptable and the General Assembly is comfortable with, but don't tie your own hands unnecessarily so you don't have to keep going back to the legislature, multiple times.
Jason, anything to add?
Some of the lessons that we've learned is one, just the depth of the need. It's hard to go into this and design a program, and I think everybody that we talked to that had built out programs like this, had run into the same dilemma, which is the demand is just simply scales much greater than any of these programs are able to reach. And so there has to be a lot of very, very strategic thinking about exactly how and who these programs should impact. Because if someone takes a some funding and then Peter butters it around thinly across a bunch of different priorities, it's really not going to be enough to impact any of the businesses. So going in with a strong mission and a strong focus, I think is really important because the competitive nature of all of these is super high, especially in grants, because right now the appetite for loans versus grants, obviously grants are a much more attractive product. And then, of course, when the government is putting forgivable PPP loans out, that's also a very attractive product as well. So the positioning has to be pretty strategic and pretty flexible. And then, I guess the only other thing, Nathan, would be, the partnership aspect of this, and Jeff was talking about this already, is huge. There's no way that we would be able to scale to the demand that we saw and being able to process the amount of applications that were received without the partners that we had, like OEDIT, like CHAFA, like our local lenders. So building those broad coalitions to serve this is incredibly important. And then the last thing that's incredibly important is that, if we are trying to work with some of the hardest hit businesses, we have to recognize that there's massive application fatigue out right now. And then application fatigue is going to turn into the actual fulfillment fatigue, because all of these businesses that maybe received a PPP loan, an EIDL advance, an EIDL loan, maybe they got another source like the GAP Fund or the Climber. They may have now, like administrative and accounting duties for each one of these. And so these programs are building a burden on top of people, even as they help them. So the way that we can help folks navigate that process, direct them to the right source of funding, so they're not applying to 5 or 10 or 15 different sources and maybe getting rejections from most, if not all of those. I think that is a really important role that we all can play. We've noticed that there's just it's a really difficult landscape for businesses to navigate right now. There's so many folks that are moving in to help, which is incredible, but from a business perspective, that also makes it more complicated to navigate. So there's work to be done there, I think, for all of us.
I have one more question, but I want to check with the audience real quickly before we wrap this up. If you have any itching desire to ask of our two panelists here, please ask your question in the chat. So, gentlemen, I think we've referenced that there are a number of gaps that all of these complementary programs from the federal level and the state level are all seeking to fill and address. Have we identified any remaining gaps that other states and other outdoor rec directors should be aware of as we collectively create similar programs? What have we missed?
The one that comes top of mind for me, and I don't know if missed is the right word, but I just see it as a huge need. And Nathan, that we were working on this in our committee of the Economic Growth and Stabilization Council that Governor Polis had put together. It is return to work. And especially for youth, there is going to be a huge, and there is just a huge unemployment deficit for younger workers, and I think that's an area where the outdoor recreation industry really has something to offer. A civilian conservation corps type model that provides a return to work services. There's some really great programs around the country to look at and model. But I think if we can elevate this around the country and really get young individuals engaged in outdoor recreation and outdoor type career paths through a program like that, and really scaling it at a state and a national level, that's something that would be another worthy project for everybody.
Yeah, it's a great question about what are the remaining gaps, and I think I'd maybe make a similar answer to Jason in that I'm not sure. I can't think of anything that there isn't a tool available for, but and the GAP Fund, for example, did a phenomenal job of really trying to address this gap, but it's such a huge gap that like no single one-time effort can address it. And obviously the equity, diversity, inclusion gap and historically underserved businesses and underserved communities, there's just tremendous need there. And, we're so proud of the Gap Fund and what they've done, but we know that it's just an ongoing need. I mean, we sort of, COVID made it worse, and this is sort of an effort to sort of address that and turn the tide and change our thinking. But we know that the EDI need will just be an ongoing need that's going to take our effort and focus, for years, maybe decades to come. I just think it's an ongoing huge need. And the other thing I would say is there is still so much uncertainty, right, about the economy. I mean, I think all of us, see hope and light and the vaccine and all these things. But how quickly, do we get vaccinated? How quickly does travel return? Are businesses able to fully open? Are they able to operate at full capacity? And I just think, not knowing exactly what the federal government will be able to do next and how it'll work, I just think it's going to be hard. And, one thing I'll say is, and this I think will affect your entrepreneurs for sure, the whole bankruptcy system is a mess. If you think about it, if you're a small business, and so many great small businesses will be forced into bankruptcy due to no fault of their own, they're inherently low margin, and they just, even with all these programs, they won't be able to survive. And you're an entrepreneur and you have a bankruptcy on your name. How do you get back in the game, even if you want to, after going through that for 7 years until your credit record is cleared? So how do we work with and make the bankruptcy system more equitable, whether it's character-based loans that aren't solely based on credit scores by nonprofits? I think that we're, this whole generation of entrepreneurs that are going to be hit with a staggering blow, how do we support them? And I think you guys will play a tremendous role in the OREC sector. And, there's obviously tremendous demand. I mean, we see it, but how do we make sure those entrepreneurs are supported and have the ability to go forward and take that risks and restart businesses and overcome bankruptcies?
Fantastic, you guys. Lots of good information. I think we've overwhelmed the audience as our first session for the NGA Outdoor Recreation Learning Summit. So mission accomplished. And Bevan, I think we're close enough that I want to turn it back over to you, and perhaps I have a couple minutes to go refill my coffee. Jeff and Jason, thanks so much, you guys.
Oh, sure. Thanks, Nathan, and thanks, Jeff and Jason. We got great comments in the chat section. I think people found this enormously helpful and spurring some great ideas for our members to possibly pursue.